Welcome back, everyone. Today, we're going a deep dive into, well, something that affects all of us, the U.S. economy.
Yeah.
Specifically, we're going to be unpacking the recent Federal Open Market Committee, the FOMC, minutes from their January meeting. It's kind of like we're getting a sneak peek into the minds of, the people who are steering our economic ship.
Right.
And trust me, there is some seriously interesting stuff in here. Did you know that they're basically reevaluating their entire game plan for managing the economy?
Mm-hmm.
Plus, we've got some really intriguing clues about how they view inflation, the job market, and even, potential risks that are lurking in the financial system. And to help us decode all of this, I've got our resident economics guru here.
Hello.
They could break down even the most complex economic jargon and tell us what it all means, for you and me.
Well, let's just say the FOMC had a lot to chew on at this meeting. They're grappling with a very different economic reality compared to just a few years ago.
Okay, so let's jump right in. One thing that really caught my eye was this whole review of their monetary policy framework. What's the big deal about that?
It's a big deal because it signals a potential shift, really, in how the Fed manages the economy. It's like they're saying, hey, the old playbook might not work as well anymore. Remember, the last time they did a major review like this was back in 2019, 2020, before the pandemic turned everything upside down.
So what's changed? What are they worried about now that they weren't, worried about before?
One thing that's keeping them up at night is the effective lower bound. It's basically the floor for interest rates, like how low they can go to stimulate the economy. During the pandemic, they slashed rates to near zero. But what happens if we hit another crisis? They're concerned about having less room to maneuver.
So are they hinting at new tools in their arsenal? Like, could we see negative interest rates in the U.S.?
It's not out of the question, but it's a controversial move with potential downsides. They're also looking at things like quantitative easing, which is basically, injecting money directly into the economy. The minutes don't give us all the answers, but they definitely raise some intriguing questions.
Speaking of intriguing questions, inflation seems to be the riddle that they just can't solve.
Yeah.
It's cooled down some and still not at their target. What's their take on this persistent inflation?
Well, they're pointing to a couple of key factors. Trade policy changes, like tariffs, are having an impact. And then there's the strong consumer demand. People are spending, which helps the economy, but can also fuel inflation. It's, a tricky balancing act.
It's almost like they're trying to steer between, a rock and a hard place, keep the economy humming, but without prices skyrocketing.
Exactly. And speaking of keeping things humming, the labor market is another piece of the puzzle. On the surface, it looks pretty good, right? Low unemployment, solid job growth. But the FOMC seems to be reading between the lines a bit.
What are they seeing that we might be missing?
Well, they're looking at things like the quits rate. It's a measure of how confident workers feel about leaving their jobs for better opportunities. And that rate is still below pre-pandemic levels. So while people are employed, they might not be feeling super secure or, optimistic about their prospects.
Well, it's a really insightful point. It's like we're getting a more nuanced understanding of what's happening in the job market beyond just the headline numbers.
Right. And that nuance is key for the FOMC as they make their policy decisions. They're trying to get a sense of whether we're truly at maximum employment or if there's still, room for improvement.
Okay, so they're looking at inflation, the job market, this whole interest rate dilemma. What's the overall economic picture looking like to them?
They describe it as solid, but they're not exactly popping champagne corks.
Yeah.
They're highlighting significant uncertainties, particularly around government policy changes. It's like they're driving with a foggy windshield.
Yeah, I can definitely relate to that feeling. So how do you make decisions when you can't see what's coming next?
That's where their risk management strategies come into play. They're essentially trying to anticipate different scenarios, good and bad, and have a plan for each one.
So it sounds like they're taking a cautiously optimistic approach, but they're ready to pivot if things change.
Absolutely. And that's reflected in their decision to keep the federal funds rate steady for now. It's not a sign that they're complacent, but rather that they're in wait and see mode,
Yeah.
carefully watching how the economy unfolds.
So it's a bit of a holding pattern, but they're definitely not on autopilot. They're closely monitoring key indicators like inflation, the labor market, and overall financial conditions.
Right. And speaking of financial conditions, there's another layer to this story that we need to unpack: potential financial vulnerabilities. The FOMC is flagging concerns about the banking system, corporate debt, and commercial real estate.
These elephants in the room, as you called them earlier. Why should we care about these potential vulnerabilities even if we're not, directly involved in those sectors?
Think of it like a domino effect, you know? Problems in one area can quickly spread to others. Take the banking system, for example. If banks start facing losses, they might pull back on lending, which could hurt businesses and consumers.
So keeping an eye on these potential trouble spots is crucial for everyone. It's not just about Wall Street, it's about Main Street too.
Exactly. And that's a great segue to something else the FOMC is focused on, their communication strategy. They're reevaluating how they talk to the public about the economy, recognizing that clear and consistent communication can help build confidence and stability.
So it's not just about what they do, but how they explain it to the rest of us. That's a really important point, especially in a world where information overload and economic anxiety are like at an all-time high.
Absolutely. And that brings us to a really intriguing point from the minutes. The FOMC is going through this significant soul-searching process right now.
Here's where it gets really interesting.
They're reevaluating not just what they do, but how they do it and how they communicate those actions to the public.
So more than just interest rates, they're examining their entire approach.
Are much more. They're looking at their strategies for dealing with economic shocks and how to be more effective in achieving their goals of maximum employment and price stability in this new economic landscape.
Which is good news for all of us. A proactive Fed that's willing to adapt and communicate clearly is definitely a good thing.
Exactly. And it's not just domestic issues they're focused on either, right? The global economy plays a huge role.
Absolutely.
The minutes specifically mention the FOMC is looking at a range of international developments as they make their decisions.
From slowing growth in some regions to those persistent supply chain disruptions we've all been feeling.
Exactly. It's a complex web of interconnected factors.
Which is why it's so important to have experts like you helping us break it all down.
Well, I wouldn't call myself an expert, but I do enjoy diving into these topics and trying to make sense of them.
And you're doing a great job of it. But let's get back to those potential financial vulnerabilities we touched on earlier.
Ah, yes, the elephants in the room.
The FOMC is clearly concerned about the stability of the banking system, especially given the recent rise in interest rates.
Can you elaborate on that a bit?
Sure, when interest rates go up, the value of bonds goes down. And banks hold a lot of bonds.
Ah, so they could potentially face losses.
Precisely.
And if those losses are big enough, it could create problems for the whole financial system.
Domino effect, right?
Exactly.
So it's not just about mortgages and car loans becoming more expensive.
Nope. It's about the stability of the entire financial system, which, as we know, underpins our entire economy.
Wow, that's a sobering thought.
But it's important to remember that the FOMC is aware of these risks and is taking steps to mitigate them.
That's right. They have various tools at their disposal, including stress tests for banks and regulations to limit risky lending.
So it's not all doom and gloom.
No, not at all. It's more about being aware of the potential risks and being prepared to address them.
Which is exactly what the FOMC is doing.
They're carefully monitoring the situation, ready to adjust course if needed.
And that's why we stay informed, right?
Absolutely. Knowledge is power, as they say.
But let's not get bogged down in all the technical details.
Okay, back to the big picture.
Exactly. If you were on the FOMC, what would be your top concern right now?
That's a great question. It's a tough call because there are so many factors to consider.
The economy, inflation, financial stability.
Right.
But if I had to choose one, I'd say my biggest concern would be the risk of a recession.
Interesting. Can you explain why?
Well, we've seen a lot of economic growth in recent years, but some indicators suggest that things might be slowing down. Consumer spending is starting to soften, business investment is leveling off, and with interest rates rising, there's a risk that the economy could tip into a recession.
So it's a delicate balancing act for the FOMC.
It really is. They need to raise rates enough to tame inflation, but not so much that they choke off economic growth.
Tightrope walk indeed.
And it's not just the U.S. economy we need to worry about either. The global economy is also facing headwinds, from the war in Ukraine to rising energy prices.
It's a lot to keep track of.
It is, but that's why we're here, right? To help make sense of it all.
Exactly. We're your guides to this complex world of economics.
And we're committed to providing you with the insights you need to stay informed.
So what does all of this mean for the listener?
Well, it means that the economic outlook is uncertain. There are both risks and opportunities on the horizon.
So buckle up.
Exactly. But knowledge is power. And the more you understand about the economy, the better equipped you'll be to navigate the challenges and seize the opportunities that lie ahead.
Wise words, my friend.
Thanks.
So let's continue our deep dive into these FOMC minutes. We'll pick up right where we left off in part 2 of this episode.
Okay, so picking up where we left off, let's dig a little deeper into those financial vulnerabilities the FOMC is watching.
Right, those elephants in the room. Let's break them down one by one, starting with the banking system. Why is the FOMC worried about banks right now?
Well, banks are kind of caught between a rock and a hard place these days. Rising interest rates are squeezing their profits, and they're facing more competition from, non-bank lenders. And some have made some risky bets, especially in commercial real estate.
So it's more than just those empty office buildings we're seeing downtown.
Exactly. A lot of banks lent heavily to commercial real estate developers, and with property values dropping, those loans are starting to look a little shaky. The FOMC is worried about a potential domino effect here.
So explain that domino effect for me. How could problems in commercial real estate spread to the rest of the economy?
Well, if property values keep falling, banks could face, big losses on those loans. That could make them less willing to lend money to other businesses and consumers, which would slow down economic growth. It's a chain reaction.
Makes sense. Okay, so we've got banks potentially facing losses on commercial real estate loans. What about corporate debt? That was another vulnerability the FOMC mentioned.
Right, corporate debt is a big one. Remember how interest rates were super low for a long time?
Yeah.
Well, a lot of companies took advantage of that and borrowed heavily. Now, with rates going up, those debt payments are getting a lot more expensive.
So are we talking about companies going bankrupt? Is that the worry here?
It's definitely a possibility. If companies can't keep up with their debt payments, they could be forced to cut back on investments, lay off workers, or even go out of business altogether. That would obviously have a negative impact on the economy.
So we've got potential problems in the banking system, rising corporate debt, and a wobbly commercial real estate market.
It sounds like the FOMC has a lot on their plate.
They do. And it's not just domestic issues they're grappling with. The global economy is adding another layer of complexity.
Right. The minutes mentioned international developments influencing their decisions. What exactly are they talking about there?
Well, they're looking at things like slowing economic growth in Europe and China, persistent supply chain disruptions, and the ongoing war in Ukraine. All of these factors can impact the U.S. economy either directly or indirectly. It sounds like they're trying to steer the U.S. economy through, like, a pretty turbulent global landscape.
Exactly. And they're doing it with one eye on the rearview mirror and one eye on the road ahead.
Okay, so let's talk about that road ahead. The FOMC decided to keep interest rates steady for now, but they're clearly not on autopilot. What are the key factors they'll be watching in the coming months?
Well, inflation is still top of mind. They want to see clear evidence that it's moving back toward their 2% target. They'll also be closely monitoring the labor market, looking for signs of weakness or imbalances.
So it sounds like they're in a bit of a holding pattern, gathering more data before making their next move.
Right. They're trying to strike that delicate balance between controlling inflation without triggering a recession. And remember, they're doing all of this while also keeping an eye on those potential financial vulnerabilities we discussed.
It's a lot to juggle. But it sounds like the FOMC is taking a very measured and data-driven approach, which is reassuring.
Absolutely. And they're also working to improve their communication strategy, recognizing that clear and consistent messaging can help build confidence in the markets and among the public.
So they're not just making decisions behind closed doors. They're trying to explain those decisions in a way that makes sense to everyone.
Exactly. They understand that their actions have a direct impact on people's lives, and they're trying to be more transparent and accountable.
That's definitely a positive development. It sounds like the FOMC is evolving with the times, recognizing the need for a more proactive and communicative approach to managing the economy.
They are. And as they navigate this complex and ever-changing economic landscape, we'll be here to help you make sense of it all.
Right. Because knowledge is power, and we believe everyone should have the tools to understand what's happening in the economy and how it might affect their lives.
Absolutely. So stay tuned for part 3 of this episode, where we'll dive into the specific actions the FOMC is taking to address those financial vulnerabilities we discussed and explore some of the tools they have at their disposal.
Welcome back to our deep dive into the FOMC minutes. We've been talking about these potential financial vulnerabilities, the banking system, corporate debt, and commercial real estate. And I know what you're thinking. What is the FOMC actually doing about all of this?
Yeah, that's a great question, because they're not just sitting around wringing their hands. They have a whole toolbox they can use to try and keep things from going off the rails.
So what's in this economic toolbox? What kind of tools can they use to address these vulnerabilities?
Well, one of their most powerful tools is something called stress tests for banks.
Hmm.
Essentially, they put banks through these simulated economic scenarios like a recession or, a sudden spike in interest rates to see how they would hold up.
So it's like a financial fire drill for the banking system.
Exactly. And if a bank fails the test, they have to take steps to shore up their finances, which helps protect the entire system.
That makes a lot of sense.
Yeah.
So stress tests for banks.
Right.
What else is in the toolbox?
They also have a range of regulations they can use to limit risky lending. For example, they can require banks to hold more capital in reserve, which acts as a cushion in case of losses. Or they can set limits on the types of loans banks can make, especially in areas like commercial real estate, where things are looking a bit shaky right now.
So it's about setting some guardrails to prevent banks from getting too reckless with their lending. It's like a financial safety net for the whole economy.
Right. And then there are things like liquidity facilities, which are basically emergency funding mechanisms that the Fed can use to provide a lifeline to banks or other financial institutions if they're facing a sudden cash crunch.
Okay, so we've got stress tests, regulations, liquidity facilities. It sounds like the FOMC has a pretty comprehensive approach to safeguarding the financial system. But even with all these tools, there's still a degree of uncertainty about the future, right?
Absolutely. The economy is a complex and constantly evolving system, and there are always risks that are difficult to predict or control. But the good news is that the FOMC is aware of these challenges, they're actively monitoring the situation, and they're prepared to adjust their course if needed.
That's reassuring to hear. So as we wrap up our deep dive into the FOMC minutes, what's the key takeaway for our listeners? What should they be thinking about as they go about their daily lives?
Well, I think the main takeaway is that the FOMC is taking a very measured and data-driven approach to managing the economy. They're not overreacting to, short-term fluctuations, but they're also not complacent about the risks on the horizon.
It sounds like they're trying to steer a steady course through some pretty choppy waters.
Yeah.
And they're doing it with a lot of transparency and a commitment to communicating clearly with the public.
Exactly. They understand that their decisions have a real impact on people's lives, and they're working to be more accountable and responsive to the needs of the economy.
Well, on that note, I want to thank you for joining us for this deep dive into the FOMC minutes. We hope you found it informative and insightful. And if you did, be sure to subscribe to our channel and hit that bell icon so you don't miss our future deep dives into topics that matter to you.
We're committed to breaking down complex issues and making economics accessible to everyone because we believe that knowledge is power. And the more you understand about the forces shaping the world around you, the better equipped you'll be to navigate the challenges and seize the opportunities that lie ahead.
Until next time, stay curious and stay informed.